This is a download from BFM 89.9, the business station.
Good morning, Dodge. I hope you have your winter booties on. But China's central bank has announced that it would cut benchmark interest rates by 25 basis points. This was an expected move given the latest PMI numbers were actually not up to par. But do you think this move will actually work to reverse the trend that they see in China at the moment?
Good morning, Nadia. It's going to take more. In recent months, the scale of the consumer price increases has come down. The scale of the producer price falls has widened, and this has had the effect of pushing up the level of real interest rates. So they're already fighting a battle. The latest Chinese interest rate cuts were unlikely to have a big impact, in part because much of the money being lent today is actually being used to roll over the enormous amount of existing debt. Also, the rise of a huge and barely regulated shadow banking system over the same period also means that adjustments to the formal benchmark rates do not necessarily have the same impact that they once did. So it's going to take more than just this one. Well, this is actually the second time this has happened recently. And you take a look, this last week, Federal Reserve Chairwoman Janet Yellen expressed concern over deflation, and she actually singled out a bigger slowdown than anticipated in China as a key risk to the outlook for our economic growth. So it's going to take more. It's a step in the right direction. It's going to take more, and I'm not sure more of what, because interest rates are pretty low as they are, and it's going to take more time for the markets to assimilate it.
But do you think that after China has dealt all these measures to deal with the shadow banking system to shore it up, that after the teething problems are over, maybe there's brighter times ahead?
Yes, absolutely. China is doing the absolute right thing. It's just going to take time. And right now, there's a lot of sentiment, a lot of facts that it has to combat. And it is doing so, but it will take time. And yes, once we get through this, you'll see that there's a general transition throughout the world. We are slightly ahead of others, but you're going to see that the momentum to the upside will start to gain, and it will be a virtuous circle throughout the world as opposed to the vicious cycle that we've been facing over the last year or so.
The U.S. actually revised its growth for the last quarter of the year down 2.2%, stating that this was worse than expected. Do you think this will dampen any bullishness that people have for the U.S. economy?
Well, Nadia, if you take a look at the economy in terms of the stock market, the market now is chasing momentum and playing the quantitative easing trade, and the fact that the growth, the improvement in the U.S. economy is not as much as expected, tends to give more reliance on the QE trade, and from the market point of view, that's good. Now, if you take a look in terms of our actual economy, we're doing pretty well. U.S. factories will be busier this year. Manufacturing, which accounts for about 12% of our total GDP, will grow about 3.7%, a tick above last year's pace and ahead of this year's overall GDP rate of 3.3%. The pace of hiring is also picking up at many manufacturing facilities, with some exceptions, but overall it is picking up. Growth is due mainly to rising domestic demand, which is being spurred by newfound consumer confidence and spending. We are also seeing housing beginning to pick up again, and we're looking for a solid year propelled by job and income gains, plus an increase in household formations and pent-up demand. So, bottom line, I think our economy is on the mend and is beyond where it needs to be in order to have some confidence in increasing our interest rates.
German MPs are backing the Greek loan extension. Is this a sign that resolution really is on the cards a couple months down the road, or is it literally kicking the can down the road?
Well, it's kicking the can down the road, Nadia, but not very far. And typically, you have to have a compromise where both sides feel it and also have to feel negativity. You have to really feel that they're not getting everything that they want. And if you take a look, that's exactly what's happening now. There's a substantial rebellion within the ranks of Chancellor Angela Merkel's conservative bloc that indicates a deep unease over Berlin's Eurozone rescue policy. Then you also look at the vote on Friday followed a night of violence in the Greek capital after several hundred hardline leftists marched to Parliament and demonstrated against the Syriza government's new agreement. And it's the first time that there's been this is the first major anti-government protest against Syriza. So both sides feel that they're not getting what they need, and that's for a compromise to work. Ultimately, that's really what is needed, where both sides have to give, and that is an effective compromise. So in my personal opinion, yes, Greece is kicking the can down the road, but it's not that far, and both sides are showing a willingness to work together despite not a total unanimity of opinion for it.
It's interesting that you mentioned that, of course, that there were protests against the new Greek government. It's barely out of their honeymoon period, in fact. So will this actually, help change any kind of sentiment, or you think it's a foregone conclusion?
It will change sentiment. I think Syriza, the fact that Syriza came when he was politicking for becoming in charge of the Greek effort, had to say a lot in order to get the populace behind him. That made the negotiations very difficult with the Germans and with the rest of Europe, but it had to be. And I suspect it was better to have Syriza in doing the negotiating than to have a different alternative in terms of coming to an ultimate resolution with the Eurozone. So I do think that the sides are beginning to show a willingness to work together. Also, I think there's more confidence in each other's side with regard to the other's status and the other's intent to make this thing work. So I think ultimately this will be positive. It's going to be difficult. There are going to be bumps. But if you notice, the Greek situation is no longer at the top of a list of world worries, and that's a good trend. I suspect that it's going to take much more to get through to the other side to have this ultimately work. There may have to be another extension, but it's not going to be very long, that's for sure. But at least the trend is favorable, and again, both sides are having to accept less than they wanted to.
It's an interesting time for banks, moving to that, with not just earnings, but scandals also taking place in the likes of HSBC. And of course, previously, a lot of the banks were hit with a lot of heavy fines for doing naughty things. Will this continue to be a difficult year for the banks and the financial system in general?
Oh, Nadia, I'm afraid so, yes, particularly with the major banks. Now, if you take a look at the U.S. market, there is a narrowing of the stocks that are participating in the trend to the upside, and the narrowing is starting to focus on the big cap stocks, and in banks in particular, the ones that are having the most trouble are in that area. And quite frankly, it's hard to come up with for now a reason to be buying the stocks. I mean, you take a look at Citigroup; they're facing a critical hurdle this month as they prepare for the results of the stress test that it failed last year, and if it fails it again, you're going to probably see the chief executive, the chief financial officer, and the head of risk probably under very strong pressure to step down from investors. And that's just not the environment that creates a positive attitude towards buying banks. Now, I think the investment banks, banks like Goldman Sachs, will probably have a clearer positive future. Also, Wells Fargo seems to be doing well. It's done okay so far by keeping its business simple, retailing focused, and also here at home. So it's not every bank, but it's the majority of the banks, particularly in the big cap area, where the remaining strength in terms of buying the market is faced. So in terms of comparing to other potential candidates, I would say banks are fairly low on the list of buy candidates right now.
That was Dodger Dolan, Chairman and Chief Investment Officer of London Fuse Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.